February 28, 2026. A date that will be etched into the history of global economics as the beginning of the Great Energy Fracture. The day the world's fuel supply met its greatest challenge. For decades, the global economy relied on a delicate, highly optimized balance of supply and demand. In a single afternoon, that balance was shattered and the world was plunged into uncertainty. Welcome to this special investigative report. I'm your host. Today, we examine the catastrophic 2026 worldwide oil crisis. Before we dive deep into the data and predictions, please subscribe to our channel to stay informed on the critical events shaping our world. The crisis was sparked by a rapid, unforeseen escalation of geopolitical hostilities. Major global powers were drawn into a direct confrontation in the heart of the Persian Gulf, the world's most sensitive energy zone. As traditional diplomatic channels collapsed, the strategic priority for all sides shifted instantly to the control of the world's most vital energy arteries. The peace of the last decade was over. This leads us to our first critical point: the total blockade of the Strait of Hormuz. This narrow waterway, barely 21 miles wide at its narrowest point, is the absolute jugular vein of the global economy. Previously carrying over 20 million barrels of crude and refined products every single day, the blockade effectively cut off 1/5 of the world's total daily supply. The impact was instantaneous. Gulf producers, including Saudi Arabia, the UAE, and Kuwait, found their primary export route completely severed. Millions of barrels were suddenly trapped in storage with nowhere to go. The immediate result was a supply plunge of 8 million barrels per day. It remains the largest and fastest supply disruption in the entire history of the global oil market, dwarfing the shocks of the 1970s. Point 2. The inevitable surge of global hyperinflation. When the world loses 20% of its energy in a matter of days, the price of every other good and service begins to spiral out of control. Brent crude, which had been stable at around $60 for months, shot up to $92 in the first 2 weeks of the conflict alone. The markets were in a state of absolute, unbridled panic. For the average consumer, this translated to a doubling of fuel prices at the pump in less than a month. This triggered a sharp decline in discretionary spending and hit consumer confidence worldwide. The global logistics industry was the first to buckle. Trucking companies, airlines, and international shipping firms saw their operating costs quadruple almost overnight, making many routes economically unviable. Because modern industrial agriculture is so energy-intensive, food prices followed the oil curve exactly. Basic staples like bread, milk, and eggs became luxury items in many regions within weeks. Point 3. The desperate and unprecedented reliance on strategic reserves. Governments around the world were forced to play their final emergency card to prevent a total societal collapse. On March 11th, the International Energy Agency coordinated the largest emergency release in its history, releasing 400 million barrels in a single month to try and stabilize the free-falling markets. While these reserves provided a temporary, vital buffer, they also exposed a terrifying reality. The world's final emergency safety net was being drained at a rate that simply could not be sustained long-term. In the United States, domestic production was pushed to its absolute physical limit, reaching a record 13.6 million barrels per day. However, analysts warned that the growth at all costs era had already peaked. Geologists and industry experts warned that the highest quality shale deposits were already being exhausted. The 2026 crisis wasn't just a geopolitical problem, it was revealing the physical limits of extraction. Point 4. The massive and permanent geopolitical realignment. The crisis acted as a powerful catalyst, accelerating the formation of new energy alliances that bypass traditional Western financial markets. China, as the world's largest oil importer, moved with clinical speed to secure its energy future. They doubled down on land-based imports from Russia and Central Asia, avoiding the dangerous sea lanes. Russia, despite facing intense international sanctions, found its oil more valuable than ever. The crisis cemented the power of Siberia Partnership, linking Russian supply directly to the insatiable Chinese market. A powerful new energy bloc emerged, trading increasingly in local currencies and ignoring the dollar-denominated Brent benchmark. The petrodollar system faced its most significant existential threat in 50 years. Finally, point 5. The accelerated green pivot. For many net importing nations, the 2026 crisis was the final, undeniable proof that national energy security and fossil fuel dependency were no longer compatible. Europe and Southeast Asia accelerated their energy transition plans by a full decade in a single year. The goal shifted from meeting climate targets to ensuring national survival through energy independence. Investment in battery storage, green hydrogen, and next-generation nuclear infrastructure reached record-breaking levels as countries sought to decouple their entire economies from Middle Eastern oil. The internal combustion engine, once the undisputed king of global transport, saw its market share begin to collapse as electric vehicle adoption became a matter of urgent economic necessity for the middle class. Now, let's look at the wild cards. In early 2026, Venezuela underwent a significant political transition. With the world's largest proven oil reserves, it is now viewed as the long-term relief valve for supply. However, years of chronic underinvestment and decaying infrastructure mean that Venezuelan oil won't reach the global market in significant volumes until at least 2028. It is a future hope, not a present solution. The 2026 crisis also exposed what analysts call the investment trap. Before the war, there was a predicted surplus. This led to a dangerous slowdown in new exploration spending. By the end of the decade, the lack of new discoveries made in the early 2020s will lead to structural tightness. The 2026 crisis isn't just a temporary blip, it's the first symptom of a long-term supply deficit. We must also consider the devastating impact on emerging markets. Nations like India and Indonesia, which rely heavily on imports for growth, saw their GDP forecasts slashed in half by the oil shock. For these developing economies, the 2026 crisis wasn't just about high fuel prices, it was a threat to their entire development trajectory, forcing a painful reevaluation of their energy partnerships. Perhaps the most lasting legacy of 2026 is the erosion of the petrodollar. As more oil is traded in non-dollar currencies, the United States' ability to project economic power through sanctions is diminishing. In late 2026, Saudi Arabia and China signed a historic agreement to settle a portion of their oil trade in yuan. This was the final nail in the coffin for the exclusive dominance of the US dollar in energy. Despite the global shock, the US economy showed remarkable resilience. This was driven by a massive wartime-style mobilization of its domestic energy and technology sectors. Nuclear energy saw a sudden bipartisan resurgence in the US. New small modular reactors were fast-tracked to provide stable, carbon-free baseload power for the growing AI and manufacturing sectors. Congress passed the National Energy Security Act of 2026, which provided trillions in credits for everything from offshore wind to advanced geothermal energy. Peacetime politics were over. Europe, perhaps more than any other region, faced a winter of extreme hardship. The complete loss of Gulf oil forced a radical, and sometimes painful, restructuring of its industrial core. The crisis led to the de-industrialization of certain sectors that could no longer compete with high energy costs. However, it also gave birth to a new, ultra-efficient European manufacturing model. The 2026 crisis also solidified the China-Russia energy axis. This partnership, born of necessity and sanctions, has created an alternative energy ecosystem that is now immune to Western pressure. By late 2026, nearly 40% of China's oil and gas was being delivered through land-based pipelines, effectively neutralizing the strategic threat posed by the blockade of the sea lanes. Looking ahead, what is the long-term outlook? The 2026 oil crisis was not just a temporary price spike. It was the catalyst for a permanent restructuring of the entire global energy map. By 2030, global oil demand is expected to have passed its absolute peak. The efficiencies and innovations born during the crisis of 2026 have now become the global standard for every industry. The age of oil is not ending because we have run out of oil. It is ending because the crisis of 2026 proved that the world can no longer afford the geopolitical and economic risk of relying on it. The hard-won lessons of 2026 will shape the world our children inherit. A world where energy is local, renewable, and, above all, secure from the shocks of the past. In summary, the great disruption of 2026 was a trial by fire for the modern world. It forced us to innovate, to adapt, and to finally break our century-old chains to fossil fuels. The transition was painful, but the result is a more resilient and sustainable global economy. The crisis of 2026 was, in many ways, the birth of the next era of human progress. Thank you for joining us for this special investigative report on the 2026 oil crisis. If you found this documentary valuable, please support our work by liking, commenting, and subscribing to the channel. Your support allows us to continue bringing you in-depth, authentic reports on the events that matter most. Stay informed, and we will see you in the next report.